Being smart, you're thinking, but the world doesn't operate on some fantastic global comic book-based economy. And alas, you're right. The world economy is based on all sorts of things that are bought and sold every day. CME Group provides markets for them, from agricultural crops and livestock to metals and natural resources to stock indexes to interest rates and foreign currencies. It truly is a global marketplace, and CME Group is one of the world's biggest forums for buying and selling. Did I mention risk? At CME Group, buyers and sellers do more than buy and sell commodities and financial products. These traders come to our exchange to remove risk for their business or to make money as an investor when prices fluctuate. When you trade large amounts of anything in today's world, uncertainty and risk are the enemy. And protecting yourself from risk all comes down to speed and timing. What does risk really look like? Well, let's start back on our supply and demand diagram. In the middle of supply and demand is a meeting point where the price for a product is set. But prices, whether for corn or crude oil or even dollars, move all the time, from month to month or even from second to second. So the price of what you buy or sell today could be higher tomorrow, or it could be worth less. But there is a way for a trader to absolutely know that future price by putting it into a binding contract with another trader. These contracts are what's being traded at CME Group. They're called futures and options on futures. Agreements between two traders to buy or sell an amount of something at a future date. A buyer of a futures contract can lock in the price of an item for delivery at a future date. But before that item actually shows up at your doorstep, you can sell your contract to another buyer. In fact, most futures contracts are sold long before the potential delivery date. Only someone with a need for the product would take delivery of the final contract. If buyers aren't sure they want a futures contract, they can buy an option, which guarantees their right to purchase a futures contract at a fixed price. So, they're not obligated to buy the futures contract, but they do have the option. That way, if market prices rise or fall between today and some point in the future, traders can exercise their option and avoid a risk, and potentially profit from the change in price. With either futures or options on futures, the buyer gets a safety net in case prices move in the wrong direction.